Okay, welcome back. There's 2 minutes to go for the pre-open session. Anuj is here, hopped across from the next door studios. Anuj, hi. Good morning. What are you watching out for?
Morning, Prashant. Well, clearly not a market to carry. Yesterday, the market ended at highest point, and this morning, SGX Nifty indicating a gap down. But day traders market, so have to deal it accordingly. And the US market slightly nervous ahead of that all-important inflation data will come out. Of course, we have to react to our own inflation data, and that's also slightly negative. But one thing which the bulls may latch onto today is the Brent crude prices. They are clearly indicating that there's some softness. And my sense is that the October lows could very well mark some kind of a bottom, and that's what the indications normally are. On the Nifty, the first fight is around the 200-day moving average. Even yesterday it got defended. Third time actually we have defended the 200-day moving average of 69.87. So that remains your sacrosanct number. Remember, yesterday the put-call ratio was 0.7, and from there we had a bounce. The important level to watch is 16,818 on the downside and 17,325 on the upside. So if you're a day trader, the range to play for expiry is 17,000 to 17,200. If you're a positional trader, the range to play is 16,800 to 17,500. Put call ratio, as I said, yesterday was 0.7. It's now inched up a bit. So maybe the juicy trade of yesterday is gone. Now on the bank Nifty, it's going to be very interesting because yesterday we closed at the 20-day exponential moving average, which is very important for the bank Nifty. And it has some congestion between now to 39,500. And on the downside, you have 39,000 as support. But my sense is if the bank Nifty does not break 38,500, then this zone of 38,500 to 39,000 would be a good entry opportunity for those who missed out. But let's see how the first rates pan out.
Thank you very much, Anuj, for explaining the setup for us. We still have Aditya Suresh with us. Aditya, once again, thank you for waiting by. Wanted to get your thoughts in on the consumer segment because we've got a lot of business updates so far, and they all point to a muted volume growth in the current quarter. Just 1 month back, everyone was bullish on FMCG, citing that the lower commodity prices will boost their gross margins in the second half of the year. So everyone was buying these FMCG stocks. But now, based on the earnings updates that we've got, what's the call that you have? And what's the growth for the full year in terms of EPS estimates and the stocks that you like?
So in consumer, our messaging has been fairly selective and taking us back a few minutes. The whole point is about one small slice of the consumer is doing well, and that's at the top end. Look at the RBI kind of confidence surveys on urban mass, that remains fairly poor still. Look at kind of the data coming out on rural India, that's still challenging, right? So real wage growth is still negative in rural India. So I think there's a lot of hope and optimism that this thing kind of looks better into the second half. But that's clearly, we've had headwinds to that story, right? So we are playing this more through consumer discretionary at the top end. We've liked autos as a space as well within that. But incrementally, a lot of this trade already kind of expressed itself. So even within discretionary, we're feeling far more cautious than what we were, say, 6 months back or 12 months back. On the margins, though, I think here is something where we kind of flag that when you actually look at margin estimates for consensus, whether it be in staples or in discretionary, and you look at the trend of the past few quarters, consensus has cut margins. And so that kind of gives us a bit of confidence that incrementally, and to kind of Anuj's point about kind of commodity prices kind of softening, incrementally things perhaps look better. And that kind of gives us a bit of confidence at an aggregate level that when we're speaking about India growing at 16%, we're feeling comfortable because we've already seen the cuts to kind of consumer sector margins kind of expressing itself. In the discretionary names, I think here, using the auto sector as an example, yes, we are constructive on the cycle on PVs, etc. But because of that, we do have an operating leverage kind of comment, which is expressing itself as well. EBITDA margins are up about 200 basis points over the next couple of years. But if broader sentiment is weak and volumes are going to be soft, then there is clearly downside to what we're forecasting for discretionary. In all, I think the message is still very, very selective and cautious. Where we do have confidence is on financials, anti-consensus, positive on say IT. Everywhere else, it's fairly selective.
All right. Thank you very much, Aditya, for joining us and running us through all that you're making of things at this point in time. That's Aditya Suresh from Macquarie. Now, some F&O sort of trading setup and trades there, really. Manoj Muralidharan of Religare Broking is with us. Manoj, good to have you with us here. Thank you very much. So trades on the long side, trades on the short side, and are these intraday? I mean, day on day is just becoming absolutely unpredictable, isn't it? No real trend.
Yeah, good morning, Prashant. Rightly, you said you mentioned that no clear trend, but then there are selective instruments which can be traded today, being expiry. So the equation that we have right now in the market is there are short positions in the Nifty future, but that is at a level of around 17,220, and there is a good support closer to 16,950. So we believe this 250 odd points is where the Nifty might be in the range. But then the better trade to do for an expiry would be a bank Nifty. Go ahead and buy that closer to 38,800 to 38,900. Use a 39,000 call option for that. The upside potential intraday can be a 39,350 to 400. So a good 450, 500 points on bank Nifty is a better trade. And the constituents, I guess, you can go long on Axis Bank as well for 798 to 800. We can buy that. Let's say a stop loss of 790, and the stock has a potential to go all the way to 821. And now because we have the results coming in, we like Infosys as well. So that also can be a buy closer to 1410 to 1415. We recommend buying that. Stop loss should be 1395. And the target will be somewhere close to 1450 to 62 on that.
Okay, thank you very much, Manoj, for joining in. Let's invite Veranda Learning Solutions. They have acquired JK Shah Education for 338 crore. The entire transaction will be funded through a combination of debt and equity. And just to alert our viewers, JK Shah classes have had a very strong record of producing 1,870 CA rankers since 2001. And some of their notable alumni include Kumar Mangalam Birla, Commerce Minister Piyush Goyal, Dinesh Shah of Kotak Mahindra AMC. To discuss this acquisition and the outlook going ahead, we have Kalpathy S. Suresh, Chairman and ED at Veranda Learning Solutions. Thank you very much for joining in. This is Rima here. Can you tell, this acquisition of JK Shah, we have the revenues of JK Shah for last year, 94 crore. Could you tell us the gross margins of JK Shah and what the company did in terms of bottom line and the synergies that you see?
Thank you, Rima. We are very excited to be aligning our efforts with one of the most iconic brands in the chartered accountant training industry in the country, with over 3 decades of history. And as you mentioned, with alumni who are the who is who in India, we are extremely proud to be aligning with them to build it bigger. For FY22, their margins were about 30 crores. FY23 expected is about 35. So this is happening at a multiple of 10 times EBITDA. Based on FY25, this is happening at about 4 times discounted FY25 profitability.
Okay.
The synergies that we see in this acquisition are, I would first to qualify that Veranda is aligning with JK Shah to be the accelerator and the enabler of their plans. The first is to expand JK Shah from the current 68 locations where they exist to 350 to 400 locations in India over the next 3 years, make them as big as they are in Maharashtra in the top 15 states in the country. That would be one of the first part of the strategy. The second one is to make them the best online CA platform in India. We own a very native, very technologically high-end LMS platform that would now be leveraged to make the JK Shah CA online platform the best in the country. The third area of focus will be to extend their content, their expertise and dominance in the chartered accountant education industry to company secretary, to cost accountant, to CPA, to possibly BCom and MCom supplementary education. So we clearly see this as something where there are 2 strong players who are coming together, one with proven expertise in subject matter and having delivered very high quality education, and Veranda platform as a technologically high-end platform.
Okay, all right, Mr. Suresh, just to confirm that number, you said for this year, the acquired asset will give you an EBITDA of around 35 crores, right?
Yes.
Okay, all right. On the bottom line, is it net profit making?
Yes, it is. The business is zero debt. Okay. It's got about 70 crores of cash in the company.
Okay.
So this is a very strong business with an extremely strong balance flow.
Okay, all right. You've also put out a clause out there that you'll be acquiring around 76% and 24%, that's the balance, will be based on the turnover in the coming year, in between 2024 and 2025, but you've not given that turnover number. What is that number?
It is based on a multiple of profit that is achieved at that time.
What is that?
It is based on about 9.5 times multiple on their profitability 3 years from now. And that would be basis of valuation for the balance 24%. Another point I think that's great to highlight here is the business has been built under the strong leadership of Mr. J.K. Shah over the last 35 years. We see this continuing into the future.
Right.
He will continue to lead the business. And Vishal and Pooja will be the joint chief operating officers who have already been involved in the business for over 3 to 4 years.
Can you break up this acquisition cost of 338 crore in terms of how much debt and how much equity, and how will you fund it? Can you tell us what is the cash on your books and the debt on your books to fund this?
Currently, it is being put together as combination of debt and equity.
Right.
The equity component that's going in is over 200 crores. This is a part of the fundraise that the company just completed a few days ago in the EGM, which was approved by the members. The balance is coming from debt. Veranda itself is debt-free with about 35 crores of cash in its books.
All right, just one point on that. I mean, this is a brand, in a way, brand business, right? Word of mouth. And my colleague Rima highlighted the alumni, very strong and stellar lineup there. But you're saying Mr. Shah will remain at the helm of things?
Absolutely.
But yeah, but is there any incentive? He's selling the business, right? So is there any incentive for him to stay and kind of run it like he's run it all these years?
I think the first is to understand the person behind the organization. As you will see, the name of the company itself is his name. So it is just beyond money from his perspective. I've had long and deep conversations with him.
Okay.
He sees this as his brainchild,
Okay.
as anybody would, having created something of such stellar value.
Okay.
So this is just beyond the 24% that he will be able to encash at the end of 3 years.
Okay.
This is not so much about monetary value, but the fact of having created such an iconic brand in the country, and rightfully so, that he is very proud of it.
All right. Thank you very much. Would have loved to go into that point a bit more, but we're out of time. But congratulations, it makes sense. Thank you so much for joining us with that, and good luck as you sort of move forward to integrate that business as well. Now, it's 9:11, 4 minutes to market opening. Midesh is back with us with some trading ideas. Midesh, over to you. What do you have?
I would recommend Prashant a buy on IDFC as the call for the day. Keep a stop at 74, look for targets around 80 here.
IDFC, targets of 80. All right. I mean, that did well. IDFC Limited and First Bank both did very well yesterday. Sudarshan, what about you? All right. I think we don't have Sudarshan right now. Midesh, thanks for that. But Adani Ports is in focus. Vivek is standing by to tell us why. Vivek.
That's right. So Kotak Institutional Equities has turned positive on the stock. They've upgraded the stocks from a reduced stance that they had earlier to an add stance. And what they're saying is that they've also raised the target price to 900 from 810. Number one, right now they believe that the continues to trade at an attractive valuation of 13 times FY24 EV to EBITDA. What they're saying, Adani Ports has continues to surprise them as well as consensus street estimates on the pace at which they are acquiring quite a lot of private assets, and most of these acquisitions have been done at very reasonable valuations. That is something that they're taking quite a bit of heart from. They also believe going forward there are quite a few good private assets as well as government assets that are on offer, and Adani Ports is well capitalized as well as well positioned to actually take advantages of the offers or of the various opportunities that lie in this particular sector.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Abhishek. He's joining in to tell us what CLSA has to say on Axis Bank. Morning, Abhishek.
Good morning, Nigel. So CLSA has returned on Axis Bank. They have increased the target price to 1100 from 1050. They retained their buy call and they termed it as one of the top sectoral pick, which has attractive risk reward right now. So they say that the drag should start reversing now in terms of business momentum. The deposits which came in at a cost of margins, that is net interest interest margin was getting dragged by cost of funds. That should start seeing improvement going ahead. OPEX are on the higher side, but it should remain under control for FY24. It's one of the big catalysts that they believe in for Axis Bank. So a Citibank deal, it's a tough one, but not a game changer. Even if it doesn't happen, there will be an earnings reduction of just 2 to 3% is what they have written in their note. The quality of earnings has improved. They expect re-rating for the bank going ahead. They expect ROE of 16% or even more between FY23 to 25. So valuations of price to book value of just 1.5 times on a 1 year forward basis looks very attractive for investors. Back to you.
All right, Abhishek, thanks very much for that. We are just a minute away from a market opening at this point in time. The pre-open session indicates a 40-odd point downtick, and the Sensex is indicating a 100-point downtick. Mitesh, you got a 40-point downtick. You'd wait for a bit longer. Overall, broadly, your view is slightly negative, isn't it?
So I don't want to buy into it. I think if we break day for yesterday's low, then I would even short in the futures. We already have some put option spreads.
All right, fair enough. So we'll wait and watch. There's just a couple of seconds to go for markets to open. In terms of big news-related stocks, there are two, that is Wipro and HCL Tech, which you'd want to watch out for right out of the gates. Beyond that, maybe oil marketing companies, but to a lesser degree, to a lesser extent, and of course, a few others. But this is the start. 25 points lower is what we have on the Nifty at this point in time. And it's a slow, tentative start as expected. That's what's happening across most other markets. HCL Tech is starting 2.5% higher. This is basically what we were talking about earlier. HCL and Wipro are the cheapest of the lot, and HCL in particular, compared to expectations, has done better. Wipro is down 4.5%. Wipro numbers were in line, but 4.5% cut on that one. Infosys, which of course will report, is starting about 1/3% higher as well. Hindalco, Nigel was pointing out some of the aluminum names. Hindalco is starting 2.5% up. We've got Vedanta, which is starting 1.5% higher. Nalco is up 2.6%. And you got Mahindra & Mahindra and Varun Beverages, which are starting up as well. So this is the start which we have. I'm just only mentioning stocks with large volumes. The Nifty Bank is also starting, and it started lower and it's kind of pulled up. And we are down about 1/3% or so on the 0.5% now, 38,940 on the Nifty Bank. So that's the start for now. Nigel.
Well, a few more stocks in the broader markets, Prashant, that are doing pretty well. You have Maharashtra Seamless. The stock is up close to 4.5%. They're going to be having a board meeting in the next few days. And I think with their numbers, they'll also be considered bonus issue of shares. So that stock, in fact, is higher in trade today. Besides that, the clutch of those metal stocks that you just pointed out, Nalco is higher. You have Vedanta as well as Hindalco. That's because, the US is talking about putting sanctions on Russia. If that happens, 6% of the total globe aluminum supply goes out of the market, which is from Rusal. It happened in 2018. We saw aluminum prices spike up. And then in 2019, saw a sharp downtick once the sanctions were lifted. For the time being, the street is enthused on that. So that one is higher. Vedanta, the stock is open high with a gain of close to 3%. The street likes this acquisition, it seems. Valuation-wise, it must have looked relatively more expensive, but it appears, for the time being at least, the street likes that. Torrent Pharma is another one from the pharma pack that's doing well. On the flip side, you have Laurus Labs that's under some pressure. A few more names just to highlight that have opened up pretty much in the green. You have Anthony Waste Handling. The stock is up close to around 4% odd. So that one as well opens up in the green. Prima, what else?
Well, Adani Wilmar has opened with a cut of close to about 2.5%. In the update, the company said that macro challenges continue to impact the business and the overall revenue is expected to grow in single digits. So the street is a bit disappointed by that development. Now the stock is down 1.5%. Keep your eye on Sterling and Wilson. They came out with their numbers. It didn't look good. There was a loss at the bottom line. And I think the stock has opened with a cut of close to about 1.5%. So that's another stock. Mindtree ahead of its earnings, which come out post-market hours today, but that's opened a bit subdued. I think Mindtree had a cut of close to about 1%, 1.2% at opening. So Mindtree is a bit subdued in trade. All in all, It's pretty quiet at the index level. The Nifty and the Sensex are down marginally, 0.2%. The mid-cap index has put its head above water. But if you compare it with the rest of the Asian markets, the Taiwanese markets, the Straits, the Kospi, Hang Seng, all of them are down currently 1 or more than 1%. If you pull up some of the Asian markets, there you have it. Hang Seng now down 1, Taiwanese, but even Korea, the South Korean market, as well as the Singapore market, both of them are showing you cuts of close to about 1.5%. So in that context, a quiet opening in the Indian markets is not pretty bad. And divergent performances continue in the IT pack. So Wipro is still down 5% while HCL Tech is leading the charge with a gain of about 3%. So big 7.5% divergence seen between the two. And the valuations are pretty similar.
And Wipro is also bombed out. But surprising, the sharp reaction to Wipro. HCL Tech is, of course, we were expecting, but Wipro, a 5% cut on top of what's already...
Actually, a lot of these IT stocks went up in anticipation that, maybe even if the companies managed to report a decent set of earnings, there would be some amount of buying. They were bombed out. So if you put up a 1-week chart or a 2-week chart, you would see some amount of buying had come through in all the names, including Wipro. And just yesterday, in the last 1 hour, you saw the stock move up. Just pull up a little longer chart and then you would see that there was some buying which came through in IT stocks.
But, that's the thing, right? Even on longer term, this is the worst performer. And every quarter there is a bit of expectation that things maybe look a little different. But it is not for Wipro. HCL Tech is having no such problems. There is also, of course, a huge underperformer within an underperforming sector lately. But that is at the day's high. It's up 3.33% at this point in time. By the way, market breadth is not bad. And that kind of ties in with the point that this is a market which is doing much better than everything else. A few other names which have joined the list here in terms of gainers. Z is up almost 2%. It was not in the mix when we started talking about names. Z is at about 272, 273. Look at that. It had a large intraday move yesterday, sold off and then towards close came back and ended just about 1% lower. Mazgaon Dock, what else but higher? Mazgaon is up another 1.5%. Day before yesterday, it sold off 7-8%. Yesterday, it recouped all of it and it up and about once again. The other one is Garden Reach Shipbuilders, which started after the move in Mazgaon, but is, I think, re-rated quite significantly. Was up yesterday as well. Flat right now. And Renuka Sugars is another one which one is seeing with about 1.6, 1.7% in gains. ABB, Marico, Torrent Pharma are the other 2% kind of moves that we've got going at this point. So that's largely the gainers. There's not very much else which is happening, apart, of course, from the non-ferrous, the Hindalcos, Nalcos of the world, which are doing quite well at this point. There's HDFC Limited, which has come up as a decent-sized loser. It's down about 1.25% or so. Nigel, what else?
Prashant, Aztec Life Sciences, I don't know what's gone on there, but the stock is surged up close to 11%. So pull up the intraday chart out there. Volumes as well picking up big time. So that one is spiking up. We'll try to find out what's happening on that front. You have some of these sugar names, as Prashant said. Ugar Sugar, well, that stock is up close to 7%. Volumes picking up out there as well. So keep an eye out on that one. That's doing pretty well. And the other one that we already highlighted, Anthony Waste as well, is higher in trade. So a few stocks in the broader markets, well, they are bucking the trend as we speak. But let's get to Mahesh Patil, CIO Aditya Birla Sun Life AMC, who joins us on the show. Hi, Mahesh. Morning. Thanks so much for joining in. Well, how are you viewing the financial, the banking space? That seems to be a consensus buy out there. Credit offtake is picking up. I think in the past you've said that you as well are part of that camp. Is it time now to look at the PSU banking names, or do you think stick to the large private sector banks?
Yeah, good morning. On the banking, I think overall the tailwinds are fairly good. As you said, the credit growth is picking up. It's now in the mid-teens, and that's good. Overall, we're seeing that the corporate credit cycle is looking favorable. So the credit cost there should be lower. And the margins also, the NIMs are likely to improve because the increase in the interest rates, I think some of that benefit, should be retained by the bank because the cost of deposits hasn't gone up as much. So I think overall, the sector, both the private banks as well as the PSU banks should do well. Normally, we've seen that the PSU banks, they do well, when the overall credit growth is stronger because their expenses and their costs, they don't really rise as much. So there is a margin improvement what we see. And normally the PSU banks are more exposed towards the corporate credit. And there we are seeing that it's looking fairly benign kind of a cycle. A lot of corporates have delevered in the last 2 or 3 years, and their balance sheets are much stronger, and they are in a position now to really start leveraging further. So given that, I think the larger PSU banks or the better PSU banks, I think they should also do well. So we are also positive on some of the select PSU banks where we see the capital adequacy ratio is good, where the ROAs are improving. But over a longer term, our preference still remains with the private sector banks, which have got a retail focus.
Mahesh, it's consensus, right? To it's a consensus bullish kind of sector, but is it possible? It's widely kind of being understood that the consumer is not really doing all that well. A high-end premium segment is doing well, but sort of mass market, lower end is not doing very well. You said corporate credit is still very benign. So where is a lot of the lending happening to? It's perhaps happening into that segment. Will we will the sector wake up to another headache 3-6 months down the line? Is that a risk which, I mean, no one sees at this point? Or you think it's very unlikely?
So I think if you look at the credit growth, demand is coming mainly from if you look at the overall retail, mortgages are strong, showing a strong growth over there, and the revival in the real estate sector is helping over there. So there, one should not see any major pain. I mean, historically, we've seen the sector has behaved fairly well. On the overall retail credit side, I think while there could be some kind of slowdown because of higher inflation, and that could lead some slowdown in the consumption. But I think we don't see any large leverage in the retail side. I mean, overall leverage at the retail level is not very large. So given that, and again, we're not seeing any kind of a major stress on the job scenario. So that should lead. The biggest stress testing was done during the COVID time, right? And a lot of the retail side credit book has gone through that kind of test or the pain. So given that scenario, unless there is a serious slowdown in the economy, we don't expect any major pain on that front. And on the corporate side also, while the growth currently is slightly muted, but as one sees some of the corporates start to lever, we've seen slowly, steadily, private sector capex starting to pick up. So one would expect corporate credit growth, which was muted, that should also start to pick up in the coming year.
Mahesh, morning. Can you tell us the changes that you've made to your portfolio in the last 3 or 4 months to play the current market scenario, the volatility that we're seeing?
So in the current market, I think while India story looks fairly strong and good, we are not seeing any major impact in the domestic facing sectors. But because of the global slowdown and the sharp increase in interest rates, we have lowered exposure to some of the stocks, global cyclicals that includes metals to some extent, the IT sector, and other sectors which have got a larger linkage to the global growth. On the contrary, we have added a bit to the domestic focus sectors, be it banking, to some extent in the industrial capital goods sector. That's where we are positive. But I think by and large, I think focus in this kind of environment where there is a lot of uncertainty and sectoral also shifts, we are seeing rotation happening very fast. It's still unclear. I think focus is still on individual stocks, companies with good cash flows, earnings visibility. I think it's more bottom up rather than a top down focus what we are adopting in our portfolios.
Mahesh, what about autos? Supply side issues getting sorted out. I understand that demand on ground is pretty good as well. But those stocks have already had a good run after a bit of a slump in the last year. What's your stance on auto stocks as of now? And what's your preference? Are you in the CV bandwagon or do you believe that the other sectors will fire now?
So in autos, we are, outlook is improving, no doubt about that. We've seen the volume pick up, especially in the four-wheelers. That's doing well. Even tractors and other sectors are doing well. Commercial vehicles, after 2-3 years of downturn, we are seeing that pick up slowly on the back of improving economy. So overall, the outlook is definitely looking good. But I think our view on the sector is slightly neutral because the stocks have rallied. Some of these valuations are probably slightly on the higher side. But I think companies which are able to protect their margins or have a pricing power and get the benefit of the lowering of the raw material costs. We see a sharp correction in the material costs, especially steel, aluminium. The metal prices have come down. So companies which have got a better competitive position in the market and pricing power, I think we should see some upgrades to earnings going forward. And that's where we'll be positive on. So that could essentially be in the more in the four-wheeler space rather than the two-wheeler space.
Got it. Mahesh, do you own any of these defense names in your portfolio? Anything new you've added there? And broadly a view? Everything is re-rated now. I mean, the laggards have also now picked up and have done quite well. I'm talking about names like Garden Reach, even Cochin Shipyard. Mazgaon, of course, over the last month is up 45%. Yeah.
So defense, I mean, we as a top-down, I think it looks fairly exciting because the way the government is focusing in terms of sourcing more from the domestic players. And while the overall defense budgets, we don't see that increasing significantly. But sourcing from domestic players, I think that's likely to go up. And the government has identified various parts and sectors, okay, where we'll do so. So the macro top-down story looks good. But when it trickles down, really, there are only a few companies, large names, okay, where we find comfort. But as to also look at this, some of these projects are also long gestation periods. So to what extent one would want to factoring in now and give those multiples is something which we need to look into that. So our preference there would be more on the larger names rather than the small and the medium names.
Would that hold true even for IT companies? You said you pulled back some of these global-facing themes like metals and IT. But if you were to take exposure to IT, would you prefer the larger names out there because maybe they could stand the test of time? They'll have pricing, power with them as well.
Yes, so IT sector, I think now post the correction, what we've seen, almost like a 20% correction or more, they are looking now fairly reasonable in terms of valuations and even in terms of outlook on growth. While there'll be some moderation, I think the margin pressure which was expected earlier is likely to abate because we're seeing the pressure on the wage increases is now kind of easing off. And with rupee depreciating, that should aid. So I think IT sector at this point in time looks fairly okay. The earnings growth should be steady. And a lot of these companies have generated very good free cash flow. So the free cash flow yield there should provide support over there. So while the global sentiment is negative and we've seen correction across IT stocks globally, Indian IT sector, they're focused on digital. I think especially the larger companies, I think should we don't see any major downgrades to earnings. So we are not as negative as what we were earlier and would be probably neutral at this point in time. But you're right, I think the preference would be more for the larger names because in the smaller mid-cap IT names, okay, there could be larger impact because of the slowdown globally. And they could probably face more pressure on the margins. But there again, I think one has to be selective. There are companies in the mid-cap space which are focused on niche segments, which are still doing well. So that differentiation has to come in, especially in the mid-cap side.
Okay, absolutely. Mahesh, it's a pleasure. Thank you very much for joining us with that perspective. Mahesh Patil, one of the largest equity fund managers in the country, with that perspective coming through. The market, I mean, the index level is not doing anything notable. We're down 25, 28 points. Stocks, of course, are moving around. And IT is, there's more losers which have joined the list. There is TCS, which is down a full 1%, and L&T Info, which is also down 1.5%, more down than up. HCL is still holding with a 3% gain right there. But a lot of it, of course, what we're talking about is global in nature. So who better than Dan Feynman, co-head of equity strategy, Asia Pacific at Credit Suisse, to answer some of these questions in terms of what he's making of what we're seeing. Dan, great to have you back on CNBC TV 18. Thank you very much for your time. Your view has been that some of this global pain will continue in terms of recession, which perhaps is inevitable in the West, but emerging markets will be more resilient. because export dependence compared to previous periods of stress is much lower, and that holds true for India as well. Just to clarify and crystallize that view in terms of levels, for the US, in your opinion, Dan, what's the downside? And relatively speaking, I don't know if you have a view on the Indian index, benchmark index, the Nifty, what could be the downside here? Go on.
I think much more downside risk in the US than India. The problem in the US, as everyone knows, the Fed is going to have to be raising rates. We're concerned that markets are still a bit too optimistic about what happens in 2023. I think people are prepared for this year, but we aren't expecting a pivot for the Fed to start cutting rates next year. We think that rates will stay high next year. We're also concerned about EPS cuts in the US. We've seen EPS cuts start to come through, but we think that from peak to trough, that EPS will be brought down something like 20% in the US. And we're only in the early stages of that process. And then markets don't yet appear cheap. The PE still looks expensive to us in the US. So there are a number of headwinds facing American stocks, and that's much more than what we've got in India. In India, we have some problems. We have a balance of payments challenge. The currency is probably overvalued, but the economy is doing much better than what we will be getting from the US. There is EPS risk, but I'd say less than in the US.
All right. Hi, Dan. Morning. The Indian economy on ground, at least, it's showing some bit of traction, which is pretty good news. And maybe we're relatively placed in this, gloomy global scenario. But earlier, you were drifting more towards, say, markets like China, as well as Thailand, I think so, because India was valuation-wise more expensive. What's your latest stance?
We really haven't changed our views there. India, I think, in a global context, looks pretty good, but in an Asian context, I think there are better opportunities elsewhere. As you noted, you've got some smaller markets in Southeast Asia, like Thailand, that have really quite a good short-term outlook. In Thailand, it's about the return of tourism. In China, you've got monetary policy easing, which is pretty unique for a major market on a global basis. India, the macro looks good. The problem, as you mentioned, is the valuations, and the valuations just keep getting more and more expensive in relative terms. The PE of India relative to global equities, relative to Asian equities, all-time high. We're in uncharted territory, and that makes our foreign clients feel uncomfortable.
All right. So, Dan, just to get that right, your preference would be Thailand, China, and then India?
Well, ASEAN in general, the Southeast Asian markets in general, whether it's Thailand, Malaysia, Indonesia, we would prefer all of these to either India due to the valuations or China because the structural story in China is not great and because of zero COVID.
What's the extent of downside that you anticipate in the US for the US markets?
Well, as I mentioned, we think that you can get maybe another 15% of EPS cuts in the US. The PE for the US looks 5 to 10% overvalued. So there's still plenty of potential downside if we were to get a fair PE following a full course of EPS cuts.
Dan, you began by saying you don't expect a pivot in terms of rate cuts, but a pivot could be a mini pivot when they stop raising rates, right? Not a complete pivot. Will that do it for the market, in your opinion, or no? And how far out are we? I mean, the terminal rate is at about, what, 4.7% right now. What is your sense?
I think that we need two factors to become either less negative or outright positive. One is that rates need to peak, or we need to be able to know where they're peaking and be close to the peak. And secondly, we have to get more of these EPS cuts behind us. Now, maybe as we turn into the first half of next year, we might want to be getting back into the market because markets anticipate, they discount in advance. You don't want to wait until the Fed has already made its last hike. You don't want to wait until markets have made their last EPS cuts. You want to get in maybe 6 months in advance of that. So potentially the bottom for the market could come well before the bottom for EPS or the peaking of rates.
Dan, just one more thing. If earnings cuts are going to be to the tune of some 20% in the US, right? I mean, Indian IT services companies, the largest set of customers are some, large US corporations. I mean, actually, small, medium, big, but that's the largest cohort of customers for Indian IT services companies. Will we see pressure there as well? I don't know if you have a view, because that is one sector here in India, large sector, very profitable, which is a big underperformer. It's not participated as the rest of the market has bounced back quite strongly.
Yeah, I would not be overweighting anything in IT, whether you're talking about hard tech or soft tech at this moment in time. You've got much more robust economies in Asia. India would be an example of that, than you have in developed markets in the US and Europe. So ideally, you should be positioning yourself in companies that are focused on the domestic economy rather than selling into the US and Europe.
All right. Dan, I wanted your view on dollar. Earlier there were a call that maybe dollar index is likely to peak out. What are you tracking in terms of the dollar index? That's the first part. And crude oil prices as well. They were threatening to go to around that $100 per barrel. But good news from an India perspective that it's cooled down a little bit. Any view on both those two asset classes?
Well, I think the dollar will probably retain for some time a bias towards appreciation against major global currencies. The rate differential is only going to get bigger. We're not anticipating enough of a change in policies from the BOJ or the ECB, and especially the BOJ, to stop dollar appreciation against those currencies. So the dollar is still probably a fairly good bet on, say, a 3-month view. Asian currencies, they will probably just be following the lead of the dollar in general. And I think Asian currencies outside of China and Japan will also face some headwinds.
Dan, but being underweight India this year has not really worked for investors, right? Because India has shown resilience not just in its economy and domestic demand, but even in terms of a stock market performance, it's outperformed, most of the markets so far this year. And although we've not seen inflows from FIs, we've seen huge outflows. The financialization of the domestic economy has made sure that money keeps coming in. So aren't the investors feeling left out? Because this is where, we've seen the money.
Well, first point is we can exaggerate by looking at the foreign flows data, how bearish foreigners are on India. Foreigners have been selling most places globally. Foreigners are just moving money out of equities and moving it into fixed income. India is not the only place in emerging markets or developed markets where you've seen outflows. What makes India special, and I think what has enabled it to outperform, is the scarcity of growth stories in the world right now. You don't have a growth story in really any developed market right now. China is sort of a bumping along the bottom story. You do have very good growth stories in the ASEAN markets in Southeast Asia, but they're quite small. India is the biggest market globally that actually has a positive delta on growth, that has something of a recovery story.
Dan, very briefly, do you expect a pivot in China post this Sunday?
Well, I think the key for a big return of foreign money to China would be a change in the zero COVID strategy. And I don't think that's going to happen soon, and I don't think it's going to happen quickly. So I'm not expecting in the short run a major change in funds flows into China. We've seen a number of people who have been putting money into China, sort of China by default, because the other big global markets look worse. but I don't see strong positive catalysts from an absolute performance perspective in China on the near-term horizon.
Dan, it's a pleasure. Thank you very much for joining us here on CNBC TV 18. Appreciate your thoughts and time on the program. Thank you indeed. Well, the markets at the day's low, we are down 70 points. So, I mean, we started 25, 30 points lower, but that's picked up on the downside and just at about 17,050. You know, Wipro is down 6% now, so that's picked up pace on the downside. ONGC is down joined the list of losers, 1.5 lower at number 2. TCS, I was pointing out, that's down almost 1.5% now. Adani Ports is down 1. I mean, actually, a lot of what was down is down a bit more, but new names there. SBI Life, Bajaj Finserv, Bajaj Finance, all down just under 1%. We'll come back, take stock of markets in some more detail. Stay with us. We'll also have Keshav Bhajanka of Century Plyboards to discuss